In this video, we are going to talk about 10 investing tips by Warren Buffett. So before starting, please like this video and subscribe to this channel for our future updates. Second richest man Warren Buffett shows no signs of slowing down. Buffett's investment advice endures. There are so many investing blunders I've made over the years, but almost all of them fit into one of Warren Buffett's 10 categories. Investing with Buffett's recommendations can help investors avoid typical pitfalls that harm returns and risk financial goals. Here are 10 investing tips by Warren Buffett. So let's start. Number 10. Invest in yourself before you invest in anything else. In 2011, the University of Nebraska-Omaha began hosting the Genius of Warren Buffett class, where one student inquired about what he should study in his spare time. Most people's income comes from earning power in their chosen profession, said the Oracle of Omaha. So, to generate money, spare time is better spent honing professional talents than studying investing. A stockbroker's assistant advised Buffett to take in a Dale Carnegie public speaking school to better interact with his clients, who would prove vital to his early success. Number 9. Never compromise on business quality. Identifying good quality businesses is significantly more difficult than saying no to intricate enterprises and industries. The previous 50 years have seen Warren Buffett's investment philosophy shift towards buying high-quality firms with long-term growth prospects. The term Berkshire Hathaway stems from one of Buffett's worst ventures. Buffett bought Berkshire, a textile manufacturing company, since the price was low. He felt that if you buy a stock cheap enough, you'll get some unexpected good news that allows you to sell it at a profit, even if the company's long-term performance remains poor. With experience, Warren Buffett shifted his opinion on cigar but investing. He said that unless you are a liquidator, buying enterprises like that is unwise. The original bargain price may not have been so great after all. In a difficult business, one problem leads to another. These businesses frequently have modest returns, further depreciating the initial investment. Number 8. When you buy a stock, plan to hold it forever. How long should a high-quality business be held after purchase? In other words, don't think about owning a stock for 10 years, only 10 minutes. Buffett. We like holding forever. Buffett. Warren Buffett certainly believes in buy and hold. Some of his posts he has held for decades. Why? For one thing, it's hard to locate great companies with a promising future. Buffett runs a concentrated portfolio for this reason. Quality businesses also yield significant returns and grow in value over time. Time, as Warren Buffett remarked, is the wonderful business's friend. Fundamentals can affect a stock's price for years, rewarding patient investors. And trading activity destroys investment returns. Buying and selling stocks frequently reduces returns due to taxes and trading charges. Instead, we should buy right and wait. Number 7. Diversification can be dangerous. My opinion is that individuals benefit from diversity the best when they own 20 to 60 equities across industries. But many mutual funds hold hundreds of stocks. Contrarily, Warren Buffett is. Buffett's largest investment was 35% of his portfolio in 1960. The market rarely offers exceptional firms at reasonable rates, but Warren Buffett buys with conviction. Excessive diversification can be a result of fear or ignorance. It's nearly hard to maintain track of 100 stocks and all the news that affects them. The impact of a portfolio's high-quality holdings is diminished by excessive diversification. Number 6. Most news is noise, not news. Every day, my inbox is flooded with financial news. While I am known for skimming headlines, I ignore practically all other information. The 80-20 rule states that around 80% of outcomes may be traced to 20% of causes. In terms of financial news, I believe the 99-1 rule applies. 99% of our investing decisions should be attributed to just 1% of the financial news we absorb. The businesses I invest in have so far stood the test of time. Many have been around for almost a century and have faced virtually every unforeseen hurdle. Imagine how many doom and gloom news stories they spawned. But they still stand. Is it important that Coca-Cola missed quarterly earnings projections by 4%? Should I sell my Johnson & Johnson stock because it has lost 10% since I bought it? Number 5. Investing isn't rocket science, but there is no easy button. One of the biggest myths about investing is that only intelligent people can pick stocks. Intelligence alone, however, is not a reliable predictor of investment success. It doesn't take a genius to invest like Warren Buffett, but it is difficult to continuously beat the market and avoid behavioral blunders. Either way, investors must remember that there is no magic set of rules, methodology, or easy button that can outperform the market. And it never will. In my opinion, anyone professing to have such a method is either ignorant or a snake oil seller. Alert AUX gurus hawking a hands-off, rule-based investing strategy. The owner would not need to sell books or subscriptions if such a system existed. It's simpler to deceive than to convince. Twain. Investing is a challenging art that involves thinking and shouldn't be easy. Number 4. Know the difference between price and value. Non-stop stock price pressure. Investors seem to be fixated on the screen's ticker quotes. The stock market is full with people who know nothing but the price of everything. Fisher. But stock prices are intrinsically more volatile than fundamentals, in most cases. In other words, there are times in the market when stock prices have little association with long-term corporate prospects. During the financial crisis, investors sold out all companies, regardless of business quality or long-term profitability potential. Many companies strengthened their competitive advantages during the crisis and emerged stronger. That is, the stock price was, temporarily, detached from the underlying business value. Long-term investors should follow Warren Buffett's investment advice and buy quality when it is cheap. Investors must discern between price and value, focusing on high-quality companies trading at low cost today. Number 3. The best moves are usually boring. Stock market investing is not a quick way to get money. In fact, I believe the stock market is best suited for long-term capital growth. Investing isn't supposed to be fun, and dividend growth investing is especially cautious. Investing in proven winners is generally preferable to trying to identify the next big winner in a new area. After all, the goal is to select great companies that will grow in value over time. So long as we get this right, our portfolio will do well. Soda, beverages, toothpaste, medicine, convenience stores, etc. While not the most thrilling jobs, industry leaders often benefit from glacial change. This has benefited many dividend aristocrats and dividend kings firms. Number 2. Low-cost index funds are sensible for most investors. Isn't it true that most investors underperform the market? The market timing, excessive risk-taking, trading on emotions, and more all hurt our results. Worse, many actively managed funds impose high fees that cut into returns and dividends. In 2013, Warren Buffett advocated for passive index funds, despite being possibly the greatest stock picker of all time. Investors who do not care about earning consistent dividend income should choose low-cost passive indexing. ETF dividends tend to be lumpy and more susceptible to cuts during bear markets. Most stock pickers don't deliver enough returns to justify their increased charges. Number 1. Only listen to those you know and trust. Warren Buffett highlights the necessity of only investing in trustworthy, professional management teams in his shareholder letters and in frequent interviews. Simply said, Warren Buffett selects his company partners and managers with extreme caution. Their actions have the potential to make or ruin a long-term investment. Warren Buffett is clearly far better connected than the rest of us, which aids him in determining which management teams are the best and most reliable in a given business. While we may not have the means to assess the character and skill of a public company's CEO for investment purposes, we can surely choose who we listen to when it comes to making investment decisions and managing our portfolios. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.